Welcome to Venture with Joe and Cody, where we take a deep dive into the minds of leaders and innovators making a real impact today. I'm Joe.
And I'm Cody. And we're here to bring you the raw stories, the successes, and the setbacks that these trailblazers have experienced in their journey to where they are today.
Every week, we sit down with a new guest who's ready to share their insight and advice on business, entrepreneurship, and making a difference in their community. From local community members to industry experts, you're going to get the unfiltered truth behind their success.
So whether you're an aspiring entrepreneur, a seasoned professional, or just curious about the business world, join us for a journey of learning and inspiration.
So let's grab a drink, settle in, and let's get started. This is Venture with Joe and Cody. Hey guys, we're back with another episode of Venture with Joe and Cody. That's Cody. This is Joe. You're with Residential Mortgage. I'm with EXP Realty.
Yeah,
I have to say that I have to start like the whole lawsuit, the NAR lawsuit, all this, everything's still continuing to kind of come down of like allowing people to not be deceived by different tactics agents used in the past and things like that. So I have to be much better about, I'm getting very mortgagey about who my actual broker is, EXP Realty, because I don't want anyone to be fooled that it's Skipper Realty Group.
Right.
Still undetermined if I can use Skipper Realty Group in the future. I think there's a short session in the Oregon legislature that's going to maybe talk about deleting that, like a clause that basically doesn't allow realty or realtor or whatever. There's a bunch of different terms that you can't use. So it's up in the air. So we may be thinking of, if I don't get it, if they don't change this law, you and I may be thinking of a new name for my company. So that'll be fun, because that changes all the marketing and everything, and all the materials just get chucked and wasted. Yeah.
All that time and money and energy.
Yeah, that's awesome.
Yeah. Yeah. And so like, do you know it can't be, because you currently have it, Skipper Realty Group powered by EXP or with EXP, right?
Yeah. And right now it has to be immediately visible. So in all our marketing, it used to be like, all of them are vague terms, and they've been vague terms forever. But basically, like, someone has to be able to immediately see who your brokerage is. So they still don't define what that is, but you can't like put Skipper Realty Group and then like in a bottom footnote where you need a magnifying glass put EXP Realty.
Sure.
We do a good job of like just putting it under our name so that people can see it right when they see our name, they see EXP. So I don't think we're too worried about that. It's more of our team is Skipper Realty Group. And so realty in and of itself is a term that's no longer going to be allowed if we can't get it changed in the short session in Oregon. And so that will all have to change. So I don't know what that'll change to. So we're hoping that it gets addressed. I'm not the only one that has to deal with this. As you know, most real estate agents have some sort of realty or realty group or some sort of thing. So it's going to affect a lot of people.
Yeah.
Anyways, we're going through that. But
STG, Skipper Team Group.
Skipper Team Group. We were like, what could SRG mean other than that? And so we were trying to figure out different terms, but it's just none of it works.
Skipper's Rule Group.
Yeah, you could do that. Yeah. But then you have to explain to clients that that's your name. And so that doesn't work either. So
you're like, listen, there were some rules that changed. We didn't want to change our branding, so we just put a different name in there for the R.
Exactly. No, we'll figure it out somehow. Hopefully it just is a non-issue in the next month or so. But
yeah.
So today, wanted to chat about, first we'll start talking about the Trump stuff and President Trump's decisions to the real estate market. Yeah. Whether you hate him or not, he's a real estate investor and knows the real estate market more than probably most politicians or presidents. But whether you, again, not stating a claim on, whether he's right or wrong, just like he knows the real estate industry and trying to make it more affordable for people. So he came up with some decisions over the last couple of days. So we're going to talk about those, and then we'll talk about kind of the new year and what buyers should ask their lender, what they should be looking for in a lender, and some of the different programs or offers that may serve them in 2026. And then finally, if we get there, because you and I blab a lot, we will go to kind of the same thing in the real estate side. Well, as a buyer, how do you, once you're pre-approved, you know what you got, what should we ask for to kind of improve your position as a buyer in today's market? So yeah, let's start it off. Like you know a lot more than I do about the Trump thing and what he's saying. So what kind of went on and what are we dealing with right now?
Yeah, so it was last week. I don't remember exactly what day it was, but Trump had put out there that he was ordering his people, his officials within Fannie Mae and Freddie Mac, who essentially run the conventional loan market, if you will, to purchase $200 billion worth of mortgage treasuries bonds, which will in turn lower the mortgage interest rates. Because as we've talked about before, when the Fed's been dropping rates, that's been good, but that is not necessarily directly related to mortgage rates. That is overall, that's a little more of the short-term rates. Mortgage rates are long-term rates. So different market tend to go in the same direction, but there has been a big focus over the last, I don't know, call it 6 months or so, of calling out the Fed for bringing rates down, bringing rates down, bringing rates down. And this to me feels like a way where he is saying, hey, if this isn't going to happen at the pace that I want it to happen, I'm going to try to find another avenue. And the 200 billion number was it wasn't just a randomly thrown out number there. I was reading an article and it was talking about that the 200 billion is essentially the max on what could be done without any type of congressional approval. So it is a sort of a strategic number of like, hey, let's do this and let's get this ball rolling. And you just need to go do it. We don't have to run this through everything and get approval. And Fannie Mae and Freddie Mac have that ability to do so. So looking into that, there was a quick reaction. Mortgage rates came down quickly for like 20 minutes while everybody was sleeping. And then the market did what it tends to do, which is just kind of like it's a knee-jerk reaction. And then the market kind of leveled back out to where it was.
Yeah.
I think the message was sent, obviously, and they have not, from what I have seen, and I looked up just right before we got on here to see, nothing has been activated yet. Nothing has been purchased from them yet. So as of right now, you haven't seen any market move that has been due to the 200 billion in purchasing. We also don't know if that is going to be, I don't imagine it's going to be a one-time purchase of 200 billion. I got to imagine they're going to phase it. It might be 10 billion at a time. I don't really know what that looks like to where they can kind of ease into it. But my first thought was, all right, well, what does 200 billion do to the market? Because I don't know if that's a big number or if that's a small number. So I started looking, and the best answer that I could find, or the most common best answer that I could find, was that it would change the interest rates on average anywhere from about 1/8% up to 0.5%. So could be a very small mover, or it could change the rates by 0.5%. And what everything was talking about was it is not necessarily directly based on that 200 billion. It's also the reaction of other investors, because as those bonds and treasuries get bought up, then it's going to increase the price for those. You think of it as a stock, right? The more people start to buy it, you're like, holy smokes, this stock is going nuts. I better get in now before I'm left behind and wishing I would have bought it. So same kind of thing applies to where if there's enough momentum, if the price of those bonds and treasuries start to go up enough, then other investors are going to kind of pile on, and it'll just snowball a little bit more. But if not, then it looks like the potential could be 1/8 to 1/4% drop.
And that would be long term then?
Yeah. And I don't. There's a lot of unknown with it, because nothing has really been specified of here's the plan on what is going to happen. Here's how long they're going to hold it for. Here's this. It's just been like, let's do this. And so we're all kind of left to speculate and try to gather as much information as we can. So that part is unknown. If that's going to be a temporary thing, or if it's like, hey, let's hold on to this until things really start to improve, and then they can kind of gradually back their way out. But while I'm ranting, I started to look, because I'm like, all right, again, 200 billion. I don't know what kind of impact that has. Where was the Fed sitting? When COVID happened and they started to bring rates down, what did that look like? And keep in mind, before COVID, the official COVID rate drop, mortgage rates were they were in the low 4s. So obviously better than where we're at right now.
Yeah.
But in 2020, before everything really started to shift, the Fed was holding about $1.4 trillion in treasury notes. By middle of 22, they had increased up to 2.7 trillion. So they'd almost doubled what they had put into their portfolio, if you will. A $1.3 trillion increase. So that to me kind of showed me, all right, if we went from 4% rates down to just call it 2.5 for a while, that was 1.3 trillion that did that. So 200 billion, it does make sense. It's not going to be this major, like, holy smokes, we're going back into the COVID rates. This really probably will be 0.25%, maybe 0.3%. I don't know what that could look like. But as of right now, not today, but as of January 20th, the Fed currently holds 2.04 trillion in treasuries. So more than what they had in 2020, which is kind of crazy, right? Because we're seeing that our mortgage rates are not where they were at in 2020.
Yeah.
So I think it's not all just as simple as the more they buy, the lower they're going to get. I think it takes the buy-in of all of these other investors and people that are like, I'm jumping on this. This is the only safe thing right now. Let's do this. So I think that's kind of the hope, is that maybe there are more of these investors that jump on and pile on and start to really bring things down by purchasing more of these treasuries. So who knows?
But that was I always get hesitant because it's like the government just throws money at things, that's imaginary money that have the feds, have they always been buying into this? It sounds like they've always bought into this. It's just a matter of how much during what time, correct?
Yeah. Yeah. And I don't know for how long it's even been around. I should probably do some research on that. But yeah, as far as I know, that's just kind of their way of controlling the environment. So when things are going great, they sell off. And when things are going bad, they buy to try to keep things more affordable.
So it's not necessarily uncommon what he's doing.
No.
No. It's just, it's just a step.
I think just in the kind of traditional Trump fashion, he's like, look, I'm going to get this done. And if the Fed's not going to do it, then I'm going to find other ways to get it. I'm going to put enough pressure to try to make this work, which I will say, again, housing affordability has been a hot topic, at least in our world, right, for a while. Because ever since rates started to go up, it's like, okay, that puts a lot of pressure. And then rental prices go up because now mortgage prices have gone up. So it's been a thing for a while. And I'm liking what I'm seeing as of late, that it's like inflation. Let's get that under control. Okay, that's under control now, or at least better than it was. Now let's really start to hone in on the housing affordability. So it's exciting for me, and I think for all of us, to think, okay, this is the next thing that is going to hopefully start to make some changes. Because lately, we've been seeing some improvements, but I think we're still to a point where I don't know that there's a lot of people that would say housing is affordable right now.
So I'm assuming, this is probably a safe assumption, this $200 billion is not something that they had in their savings account and they're going to use it. This is this eventually going to trickle down to basically more debt for the U.S. economy or U.S.?
No, from what I have seen, it is surplus that Fannie and Freddie have.
Okay.
Yeah. And I had seen that, not necessarily that question, but that information was put out there, that, there was a lot of pressure to close down Fannie and Freddie a little while ago.
Yeah.
And they didn't. And now this is part of their surplus. So they can directly do this based on extra funding that they have to help.
And it sounds like there's no other approval. So this could theoretically happen tomorrow because he doesn't need the approval to do it. It can be done.
Yeah. And I don't know what the red tape looks like from their side and who needs to be involved. But from what it sounds like, it's ready to be applied. It's just probably figuring out, how quickly do we do this? How much do we do? How long do we hold for? What is realistic?
So if this goes, do you see a direct correlation? Is this still a guessing game? Or do you see, like, if they put $200 billion into this, whether it's eventually or whether it's over time, will rates drop? Is there a direct correlation? Or is it like one of those things where when the feds, like we talk about all the time, feds say something, we think it's going to drop, it doesn't.
Yeah.
Or it goes the opposite. Is this something that has a direct effect on the rates long term in a good way? Or is this another one of those, we'll see how it goes?
Yeah. I really think that it will have a direct impact.
Okay.
Mainly just because the money is going to move the market.
Yeah.
And so whether it's just them and nobody else does any additional buying, I still think it's going to be enough to move the rates. Maybe not by a lot, but even 1/8% in rate, then we're going to see some type of movement from it.
Okay.
But I also think it kind of, I'm not a big investor person. Not that I'm not for it. I just don't have crazy investor money. But if I was, I would think that those are kind of like signals that as an investor, you're kind of looking at where you're wanting to put your money and where's a safe place and where's your money going to grow. And I know that was where it always seemed to be over the last handful of years prior to COVID kind of throwing a wrench in everything, but it was always just kind of like that was a safe place to put your money. So the stock market's looking ugly. People would dump their money into the treasuries and the bonds because it's like not a lot of return, but it's also very safe. You're not dealing with the volatility of the stock market. So
for sure.
Well, the stock market's going all crazy. I'm just going to put my money over here. And once the stock market seems to stabilize, I'm going to pull it out. And that's why we always seem to see like that, the fluctuation between the stock market's looking good. That means that the rates are probably going to get a little bit worse because the money is just it's just transferring from here to here. And then the stock market starts to go down the toilet a little bit and they pull it out, which then makes the stock market even worse because people are now pulling their money out of there.
Yeah.
But yeah, I do think that there'll be a direct
effect
correlation.
I know that, you were saying an eighth to a half, those are kind of the range of predictions, but has Trump indicated his thoughts on that? I know he normally has high hopes for the things that he puts in place, but has he said specifically, or is he just more putting it out there too, just saying that it will improve rates? Like, has he made bold predictions on what this would do to rates, specific numbers, or just kind of more generically?
It's been more generic. It's just been more of a, we're going to do this and we're going to bring mortgage rates down so that people can start to refinance and people can find more affordable housing.
Okay.
So I think
that's good news for the lending world.
It is. Yeah, I think so. And I don't know if you saw recently too, and it's hard to know. I don't know the laws very well or like the process of everything. So it's hard to know what is like when he says something, it's hard to know, like, will this be able to happen or is this going to get, does this have to get voted on and everything? But I did see recently that he was banning big corporations from
I saw
buying.
That. I was going to ask you about that.
Yeah, buying residential and investment properties. And, that was a big thing. And whether it's speculation or real, I got to imagine it's probably got some realness to it of, big time investors just swooping up properties because cheap rates, right? Like, now's the time to do it. Let's do this. So I think that's a good thing as well. Just starting to kind of see more of like, all right, let's get back to making it to where people that are going to live in their homes and just provide a home for their families, like give them more opportunities to do so. And I think that's a good stepping stone. And I've also seen too, not to overdo it too much here, but projections for this year for what could potentially happen in the mortgage world, a possible reduction in the FHA mortgage insurance premium. A lot of people that do an FHA loan don't really realize, or maybe it doesn't really impact them much, but there is an upfront mortgage insurance cost on an FHA loan as well as your monthly. So they're looking at potentially reducing that upfront cost, which gets rolled into your loan. So that's why most people are like, oh, okay, yeah, sure. If I don't have to pay for it, I don't really care, but it gets rolled into their loan. So that's good. That could be another slight reduction. Possible end to tri-merge credit reports. This has been kind of going around for a while, but trying to find different ways and different avenues for assessing credit, which who knows where that will go. And then the other one that I saw was reducing loan level pricing adjustments. And so what that is that is for essentially like little categories that are built into how rates are priced out. Like say you're at a 720 credit score. Well, the pricing adjustment might be that you're paying an extra 0.25% in fee because you're in that credit bracket instead of being up at a 780. Or you're only putting down 5% versus 10%. And so each little bracket has its own pricing adjustment. So they're talking about potentially reducing those costs, which in layman's terms just means that the rates would get better.
Okay.
So.
Okay. Well, do you see this like, I see anecdotally and kind of research wise that I've done is like it's looking positive in 2026 for the real estate market especially relative to 2025, 2024. Are you thinking the same thing or seeing the same sort of stuff trajectory besides barring anything that Trump is doing, but like just in general as well?
Yeah. everything I've seen has projected that it's going to be better than 26, or excuse me, better than 25.
Yeah.
But not necessarily like this booming
like smoking. It's not
year.
going to be like COVID world.
No. I've seen this year 26 being labeled as kind of the rebound year. So not that it's necessarily going to just take off and go crazy, but it's kind of like, okay, everything seems to be stabilizing, and we're in at this point now of like, okay, there's not a lot of chaos going on. You know, we're getting more used to homes staying on the market longer. Rates are stabilizing. Everything's kind of feeling like, all right, the dust is settling a little bit here.
Yeah.
From a mortgage projection side of it, like Mortgage Bankers Association, Fannie Mae, Freddie Mac, Wells Fargo, some of these big entities that will put out their projections for this coming year. Or it's so weird because I don't know if I say this year because it still doesn't feel like 26, but
it is.
Yeah. Their projections are essentially that we're going to stay about right where we're at.
Okay.
For interest rates. And this is their projection that they probably put this out months ago, right? I don't know when they put it out exactly, but from their side of it, they're looking at this thinking, all right, we'll probably just kind of hover in this general range, you know, low 6, maybe upper 5, somewhere in there. But that's just a projection. We've seen projections over the years where it's like they're going to increase or they're going to decrease by a lot. And we go through the year and it's like, wow,
and it's not
like nothing changed from January to February or January to December. We're still.
Yeah, that's why you kind of have to look at the research, but then kind of look at your own kind of pulse on what you have on your market, you know, and see, is it reacting like the national news or the national people say it is? Because even in 2025, like you had the national saying it was a pretty bad time, but you know, depending on the area that you were in, you didn't notice anything, you know?
Right.
And people were still buying, people still selling. So yeah, it's just an interesting time. But I do think that we're seeing, at least, again, research and anecdotally, these rates are kind of the people that were in the 7s and purchased or were thinking about purchasing in the 7s, now seeing things in the low 6s and potentially into the 5s. I think you're going to see not a surge like a COVID surge, but I think you will see, especially in spring, if things continue down a better path, that you may see a lot more competition than you thought that you were going to see. It's not 2025 anymore, in my opinion.
Right.
So with that being said, what do you know, there's a lot that lenders offer, different lenders, residential mortgage, different people offer different programs. As a buyer coming into 2026, what are you suggesting to them when they call? What should they be looking for in a lender? What kind of things that they should be prepped for 2026 that they may not know about? You know, because most people don't know what goes on in lending. You talk to me about lending sometimes, and I'm in the industry, and I'm like, I don't have a clue what you're talking about. What do the consumers need to know going in to make the smartest financial decision, you know, going forward this year?
Yeah. Well, I mean, for starters, I'll talk to them and just kind of try to figure out what their plan is going to be. Like, what would their ideal situation be? And then a lot of it just comes down to what they're thinking and what they're hoping is going to happen with the housing market and the mortgage rates. And so it ends up being kind of like what we've talked about a lot of, if it feels like the right time for you, like, then I don't know what's going to happen with the rates, and I don't know what's going to happen with the home prices. So I'll give you all the information that I see and know, and give you my best prediction, I guess, if you will. Like, if I was in the market right now to be buying, this is what I would be doing, which is just finding the right house, because the rates are going to change, and we all assume that they're going to get better. I don't know how much better, but at least a little bit better. There is the potential that you could refinance down the road, but at the same time, we've seen the rates come down about 1% this year. So it's hard to really know what that's going to look like. So a lot of it is on my end. I'm walking them through just what their options are. And one thing that really tends to help people when it comes to, I want to wait till rates come down. That one is like I just show them, here's what your payment looks like right now with the rates. Here's what it looks like if we come down 0.5%. Here's what it looks like if we come down 1%. And then they see that and they go, it's really not that. I mean, it's better, right? But we're talking about a couple $100.
Yeah.
And they're like, okay. So then it becomes a situation of, can you afford this now? Because if you can, you know, waiting for 6 to 12 months to try to get that 0.5% decrease in rate, we don't know what home prices are going to do at that point.
Yeah.
You're just kind of putting things on hold. So a lot of it ends up being, I try not to give too much of like my sales pitch on what I think they should do. And I'm really just trying to kind of like provide them with information on what things look like. And usually, again, that rate comparison and showing, here's what a 0.5% does to your payment. It's awesome. But is that enough to deter you from buying for another year or two? When in that time, you got to know that home prices are more than likely going to increase. When the rates come down like that, millions more people are jumping into the market to buy. So, and I'll walk them through too, just to kind of wrap up your point there of going through different like quarterly grant programs that we receive and down payment assistance options and kind of mortgage planning for what they can do and what they can't do, and just going through their options.
Do you have I know obviously lenders are different. They compete in different ways. Is there a trend that's going on now that someone as a buyer should look to lenders to ask about, whether that's an individual program through your company or whether that's whatever that lenders, because you guys have to stay competitive in some way or another. And so what should a buyer, I personally think I have reasons why you should pick a lender, but what should a buyer kind of look to in that realm, in the financial realm of like what lender is offering X, or is that not a thing?
Yeah, no, I think so. I think it really comes down to looking to make sure that what you're being offered is the best option for you. If you're in a really unique situation, you're going to want to make sure that you have a lender that can satisfy that need for you, because not every lender is going to be able to offer every option. We all have things that we're good at and that we kind of specialize in, and then we have other things that it's like our company is not participating in that, so I don't have an option for that. So finding that part out first is really important. And I mean, I will tell people too, like, find someone that you like, that you want to work with, because the rates and fees are obviously important, but finding somebody that you feel like you can work with, that you can trust, and that you get what you need out of it. Like we were talking the other day of, I think a lot of people in their mind, when they go to get a mortgage, they have a certain expectation, and our job is to meet and beat that expectation. But the expectation is, I want to get a mortgage and I want to get the best deal that I can, and I hope to not just get beat up through the process.
Yeah.
So those three things, those four things are really important for all of us. But I think as a consumer, as somebody that's getting that, you really do want to check all those boxes, because you might be able to get the cheapest online deal, but you're just going to get beat up with the quality of product and service and experience. So you leave there going, man, I'm glad I went to the dollar store, but now my experience was kind of rough.
For sure.
Or you get the other side of it, probably similar to like what your experience would be, or if somebody was coming to.
You can always go cheaper. We've talked about this before, and you can get an agent, you can get a lender with better rates, and you can get an agent that offers a better commission to you. But more often than not, it's the quality of service that you get and the benefits that you get out of that when you do. And if you're willing to sacrifice that, then, and you're open, and you're, like you said, you go over their goals. If they're like, bottom line is all we care about, we don't care if that person never calls us again. Then that may be for you. What we see more often than not is most deals can go wrong very easily and head that way very easily. And it takes a good lender and a good real estate agent to kind of guide it right back in. You may not even notice as a buyer or a seller that it's going that way. And we notice it, and kind of because of the communication and the knowledge and the expertise, you can kind of guide it right back into the path to close.
Yeah.
But I would say, like, as an agent to you, to my buyers, to lenders, I tell them to shop around. Sometimes you guys have, again, it's their goals. So it's like, hey, Cody can't offer this, so I would not give you Cody, because his company can't do that. Or Cody can do this, so go to Cody. Or this person is best with this unique thing that you need. And I think that's what's good about the lenders that I use, which are very small, a number of lenders, is that you guys are all good with, like, you get on the phone with people, find out their goals, and determine if you're going to be the help to them. And if you're not, you're more than happy to send them to someone that can. And I think that's important too, is that someone's not, promising you the world just to get your business, because it normally doesn't work out very well. And that's the same in
it
real
usually
estate world.
backfires.
Yeah, the real estate world's the same. Be leery of the agent that can promise you everything and for the lowest cost and give you the services that they need, because it's not realistic in a lot of ways, or their business structure is set up to where they need to get quantity over quality, and you're just a cog in the wheels. Anyways, but you guys do have rates and programs and different things throughout the year that come up that you didn't know were going to come up. So it's worth a shot to kind of call around and see if there are some incentives like you guys had in January. It's coming up. Well, we only got a couple weeks left, but you guys had that promo for January of buying down the rate for a year. So there's things that, you guys all offer, and I think it's really good to kind of just chat it over with someone versus look online and kind of fill out some random thing on Zillow or whatever that may be. Yeah.
So on that, like kind of the planning from our side, what are you seeing for this coming year, or what are you telling people if they're coming to you like, hey, should we sell? When should we sell? I need to buy. Should I wait? I know most people think spring and summer is like, that's the hot time to buy and sell, but
for sure.
What do you tell people?
Yeah, as the selling side, you could, ultimately, it sounds super dumb and no one wants to hear this, but it's ultimately when you want to sell or when you want to buy is the time to do it. I can tell you what the better times are in spring and summer. Spring more than summer, and oddly enough, I don't think summer is as good as people think it is, but spring is kind of the prime time to sell. But if you take into account all the things that are happening, it's not just, people tend to think very superficially about real estate and like spring, that's the best time to sell, that's it. And that may be the case in a general sense of the term, but as we've talked about, there's a lot more happening in the background with rates and things like that. And if you don't know strategically what's happening, you may think that this is the best time, but there may be another time because of, maybe President Trump's policies or things like that you're like, oh, well, it turned out fall was better because of these things that occurred through the years. Yes, I always say generally spring is better, but what I'm suggesting to some of my sellers that are ready to go whenever I say to go is to get on the front end of spring. I think already the rates are at a good rate that we've seen in a long time, just without buy downs. With buy downs are amazing. So I personally think that there'll be a lot of sellers in spring, or more than we expected, or more than we got from 2025. I think there'll be more sellers in the market in 2025. The sellers that are in the 3% range, 4% range of their home are now like, well, 5, if we could buy down to 5, it's not that, there's a closer gap. And the gap is closing between what they have on their current house and what they can get on a new house. And so we will see, I think, more sellers in the market in the spring. So I say, if you're ready to go, let's plan now. This is what I tell my sellers now is like, let's just get on the end of February, early March, like kind of get on that front end. So it's like people, you have less competition, because even like the home that I was pitching the other week is like, it's in January and it's pending within a couple days. So people are out there, buyers are out there, and they're serious. Winter buyers are definitely serious buyers. They're ones that are like, we're going for it. So sellers, I say on the front end, ultimately it's when you want to do it. I would say on the front end of spring and this year particularly. So it's kind of preparing now and getting on the front end of that kind of, I think, again, not a COVID influx, but an influx of homes that'll be on the market in the spring. For buyers, I say that, I think the inventory is low-ish right now, but you have way less competition. So I encourage buyers to look now, because we've had a few buyers that have waited till spring, because spring is when the most inventory is there. And then they're like, gosh, I can't afford it. I'm getting outbid by everyone. And and I do think that we'll start to see that a little bit more than 2025, that we'll start seeing that because of that competition, and the rates being low and buyers being able to either buy down their own rate or use seller credit to buy down that rate. I think we're going to see a lot more competition in the market for buyers. And so again, I'm telling them, start looking now, like see what's out there in the inventory. If there's nothing there, there's nothing there. But you have less competition right now, and you're going to have some more buyers coming into the market in the spring. So you'll just have more competition with the houses, especially houses that are priced right, priced reasonably. You're going to have more buyers than just you looking at them. So it's all about kind of, we set up their goals and what they want. But, if you wanted my personal advice, I think, with how the trajectory of things right now, as we've talked about in our podcasts and the live streams and all that, things are looking good in the real estate market in 2026. They're at least going to theoretically stay the same. So if you like what it is now, it's not going to fluctuate a ton, maybe fluctuate down into the fives, so that's my thoughts. That's my 2 cents that I tell buyers. I don't know if you agree or disagree with that, but
I do
you
agree.
can disagree.
I agree. I think that we've beat this drum a lot, but it's like, if the time works for you now's the time.
Yeah,
like,
for sure.
I think that there's probably plenty of people that have waited through, whether it was the COVID time because it was just nuts, or after COVID and they waited too long because now rates are up, or they waited to sell and now it's sitting on the market.
Sure.
Like, there's so many times where I feel like waiting never really pays off, even though it feels like the right thing to do. It's like, how many times do you always wait for something and then you go, man, like, as somebody who is very good at procrastinating, waiting doesn't typically pay off for me.
Yeah.
And it doesn't seem to pay off in the real estate side of things either, unless you just happen to not buy in 2008 right before everything crashed. Like, in general, you're losing money one way or the other.
For sure. If you're financially ready, waiting doesn't help. If you're financially waiting because you have to financially wait, great. You should. Don't push yourself into it. But if you're financially ready to go at these rates, and things could only get better because what we're seeing is sellers offering credits to the buyers to buy down the rate. So if you can afford now as is, and then you can get credit from the buyer or seller, there's no reason not to. If the house isn't there, then the house isn't there, and you keep looking. But don't force yourself. But there's no reason that if you can afford right now that you're going to be like, let's wait till spring, unless the inventory is not there that you want to see.
Yeah, exactly.
But if it's there and you're just like, no, I'm just going to sit on my thumbs until spring because things look prettier, I just think you may not be like hugely disappointed, but whereas sellers right now during the winter are willing to offer credits, maybe they're going to have 2 or 3 offers and they don't have to offer credit to you anymore. So my suggestion is get in now as a buyer.
Yeah, things change quickly too.
They do. They do for sure in our market. Excuse me. Sorry. Yeah.
Get that frog out.
Well, that was a good talk. We had a long talk about all that stuff that I think, I honestly do think 2026, unless something is going to happen tragically, I think we're kind of on a good track to either stabilize or be stable right now, or kind of see a little bit of dip. But we do see a lot more balance in the market as sellers and buyers work with each other versus being very lopsided. So
I agree. I feel like the sun is starting to come out, and it's starting to kind of feel like maybe everybody in the industry is kind of looking at it like, did we make it? Like, are things actually finally starting to improve and stabilize? Because it's been a long time coming. So it's exciting to look at the prospect of this year and go, hey, you know what? Everything seems to be pointing in a better direction. Even like you said, even if we just stayed put, I still think it's better than what 24 was, and it's better than what 23 was. So, if that's the worst thing that happens, then that's still a better situation.
So interesting to think about. Like, we've had this podcast for a while now, and remember talking about that. Like, okay, just make it through. Make it through. Like talking to people and being like, I know this is hard. This is hard.
Yeah.
And sellers being like, this sucks. And it was a hard time. And I do see some light at the end of the tunnel, hopefully, with this. And I start to see that, with people even in the market now that are, getting prepped to sell soon and prepping to buy. So that's good. So
Yep.
Good for the market.
Gotta love it.
Okay, man. Well, till next time, if you haven't already, like and subscribe to our YouTube page, or my YouTube page. Do you have a big YouTube page? I don't know if you do.
I do, but I haven't done much with it.
Well, like and subscribe to mine. Get on Adventure with Joe and Cody on all the Apple, Spotify, and all those ones, and subscribe and help us out with that. But until next time, my man, we'll chat with you soon.
Love it. Let's do it.
Okay. See ya.
All right. Bye.